guys, today I'll be discussing an introduction to accounting. Accounting has a long history, and we'll trace it through five important eras: the Mesopotamian era, Renaissance, early modern period, Industrial Revolution, and the Information Age. Let's start with the Mesopotamian era. Early accounting records in clay tablets were found in Mesopotamia, Assyria, Phoenicia, Sumeria, and Egypt. This means that thousands of years ago, people already kept track of their resources using clay tablets. Think of it like writing down your allowance in a notebook, but instead back then they used clay. The main purpose of these records was to record the growth of crops and herds. They tracked their animals and harvests to know if they were growing or losing resources. Early humans began living in civilizations where trading, social classes, and organized systems developed, creating the need for accounting. As people started trading and forming societies, they needed a system to record exchanges and responsibilities. Next, we have the Renaissance era. In Italy and Greece, merchants used bookkeeping to manage many transactions funded by bank loans. Businessmen had to keep track of money borrowed and sales made, so bookkeeping became important. In 1494, Luca Pacioli published Summa de Arithmetica, Geometria, and Proportioni et Proportionalita. Although mainly a mathematics encyclopedia, it contained a 27-page section on bookkeeping that explained the principles of double entry accounting and the use of ledgers. Pacioli explained the idea of double entry accounting, where every transaction affects at least two accounts. For example, if you buy supplies with cash, you record supplies going up and cash going down. That is double entry. Luca Pacioli published the first known formal book on bookkeeping and modern accounting principles. That is why he is called the father of accounting. Without his work, we might not have the accounting system we use today. Next, we have the early modern period. The Dutch, being pioneers of financial markets, were the first to issue bonds and shares of stock to the general public, which prompted the development of accounting treatments towards bonds and shares. In simpler terms, the Dutch started selling shares and bonds to people, and accountants had to make new rules to record these properly. Moving on to the Industrial Revolution. As machines became the primary mode of production, machines became considered as assets while labor became an expense. For example, a sewing machine in a garment factory is an asset, and the tailor's wage is an expense. Lastly, we have the Information Age. The rise of computers made transaction processing fully automated and introduced new ways of organizing businesses. During this time, accounting frameworks like GAAP and IFRS were also developed as the world became more globalized. So computers made accounting faster and more accurate. Also, countries created common accounting standards to make business more global. Today, a company in the Philippines can follow IFRS, and investors from other countries can easily understand the financial reports. Now that we've tackled the history, let me give the definition of accounting. It is the art of recording, classifying, and summarizing financial transactions and events of the business, and interpreting the results to intended users. Accounting is basically keeping track of money and explaining it in a way that people can understand, like listing your allowance, expenses, and savings, then checking if you have money left. Accounting is commonly referred to as the language of business. It tells the story of a business through numbers. Just like how words tell a story in a book, financial statements tell the story of how a business is doing. Accounting is a means to an end. It provides the financial information needed for decision making, planning, and accountability rather than being the final goal itself. As mentioned, accounting is useful for decision making. It organizes and interprets financial data to help individuals and organizations choose the best course of action. Accounting is used by businesses, governments, nonprofit organizations, and individuals. The nature of accounting is that it is an art and a service primarily engaged in providing financial information to interested users to help them make economic decisions. Basically, accounting provides useful money related info that helps people make decisions. The scope of accounting deals with financial information and transactions. Now that you know the definition, let me explain the three areas of accounting: public, private, and governmental. So, accounting can be practiced in three ways: for other companies, which is public, within one company, that's private, or for the government. To illustrate, a CPA firm auditing SM is public accounting. A BDO accountant working only for the bank is private. A COA auditor reviewing LGU funds is government accounting. Again, public accounting refers to providing accounting services for other companies, which generally include auditing, tax accounting, and management advisory services. Auditing deals with the review of financial statements to assess their fairness and adherence to accounting principles. It basically means checking if the reports are correct and follow the rules. Tax accounting deals with tax compliance and tax planning. Tax compliance refers to the preparation and audit of tax returns, while tax planning is advising clients on how to structure their financial affairs to reduce tax liability. Basically, it's all about helping businesses pay the right amount of tax, like making sure you file your income tax on time and legally finding ways to reduce taxes. Management advisory services deals with helping clients to improve their information systems and business performance. From the word itself, advisory services advise businesses so they can improve operations. For example, a consultant is suggesting a new accounting software to make reports faster. Now that we've covered public accounting, let's move on to private. This refers to working for a single business entity in a specific industry. You only work for one company handling its accounts. For example, an Ayala Land accountant preparing financial reports only for Ayala Land. Lastly, we have governmental accounting. This refers to keeping financial records and preparing financial reports for the government, its departments, and LGUs. This means managing money records for government offices, like a city hall accountant recording taxes collected and how they are spent. So those are the three areas of accounting. Now, let me discuss the branches of accounting. We have financial accounting, auditing, cost accounting, managerial accounting, government accounting, tax accounting, accounting education, accounting information system, and forensic accounting. These are the different areas of specialization. Just like doctors have pediatrics, surgery, and cardiology, accountants also have different specialties. If ever you need to memorize all of this for a quiz, I like to group together similar letters for easier recall. So we have 3 A's, FF, and CGMT. Triple A, FF, CGMT. Just remember that. If you're learning a lot so far, please like, subscribe, and hit the notification bell. It won't cost you anything and it would really help me out a lot. Going back, let's start with financial accounting. It provides general purpose financial reports to various external users. Basically, it means making reports for people outside the company, like investors and lenders. Next, auditing. An external audit is provided by independent auditors to check financial statements, while an internal audit is done by in-house auditors to evaluate policies and spot weaknesses. External auditors are outsiders who check if the reports are correct. Internal auditors are employees who check if systems are working well. For example, An independent CPA firm reviewing Jollibee's financial report is an external audit. A Jollibee employee checking if cash handling is correct is internal auditing. On to cost accounting. This refers to accounting and classifying costs and expenses to determine the total cost of a product or service. It figures out how much it really costs to make or deliver something, like computing the cost of making one can of Coke by adding materials, labor, and overhead. Subsequently, we have managerial accounting. It provides internal financial reports, mainly to managers, for decision making. Basically, it gives managers the numbers they need to plan and decide. For example, a sales report showing which product is most profitable helps managers decide what to promote. Up next is government accounting. As mentioned earlier, this branch prepares financial reports for the government and its agencies, like preparing reports on how the Department of Education use its budget. From there, we now look at tax accounting. This means preparing tax returns and ensuring tax compliance. It makes sure individuals and businesses pay the right taxes. On to the next, accounting education. This is accounting for the academe and research. It is a branch that focuses on teaching and studying accounting. Like, for example, a professor teaching accounting at a university. Following this, we have the Accounting Information System. It is a system that a business uses to collect, store, manage, process, retrieve, and report its financial data. It is the software and systems that help businesses handle financial data. An example is using QuickBooks, which record and process transactions. Lastly, we have forensic accounting. This focuses on legal affairs such as inquiries into fraud, legal cases, disputes, and claims resolution. Forensic accountants investigate financial crimes and fraud. For example, an accountant examining fake receipts in a corruption case. We've just discussed the branches of accounting. Now let's move forward to the users of accounting information. We have two: primary users and other users. Under primary users, we first have investors. Existing investors check if the business is performing well and if they are getting good returns. Potential investors look at performance to judge the risks and rewards before investing. Next, we have lenders and other creditors. Lenders make sure the business can repay a loan and they decide the loan terms. Suppliers or creditors check if the business can pay its bills before giving credit, and they set credit terms and limits. As for other users, they can be internal or external. Under internal users, we have three. First, owners. They monitor business performance to see the return on investment. Second, managers. They evaluate results to plan and make decisions for the future. And third, employees. They check if the business can pay salaries and benefits. Next, we have external users. These are individuals or organizations outside the company who use accounting information to assess its performance, stability, and compliance for decision making. First up are the tax authorities. They use accounting information to collect taxes like income tax, sales tax, property tax, and business tax. Next, regulatory agencies. They monitor public companies' reports to ensure honesty and fairness. For example, the Securities and Exchange Commission enforces rules against insider trading, accounting fraud, and misleading financial reports. We also have customers who use accounting information to know if the company can keep providing goods or services. On to employee unions. They use it to negotiate salaries, benefits, and profit sharing. After that, trade associations. They prepare reports to evaluate businesses and industries. Finally, we have financial intermediaries. Financial analysts create reports that guide investors. Stockbrokers check returns of current and future stock investments. Mutual fund companies monitor performance to weigh risks and rewards. Credit rating agencies assess whether a company can pay its debts and interests on time. Now let's talk about the forms of business organization. We look at them in two ways, as to ownership and as to activity. Let's start with activity. Businesses can be classified by activity into three types. Service business provides services like a law firm or salon. Merchandising or trading business buys and sells goods like a grocery store. Lastly, manufacturing business produces finished goods from raw materials like a furniture factory. Aside from activity, we also classify businesses by ownership. A sole proprietorship is a type of business owned by a single individual. The owner has complete authority over every aspect of the business. A partnership is owned by two or more people who enter into a partnership agreement. They contribute money, property, or skills and share the profits. A corporation is an artificial being created by law. It exists separately from its owners and has powers and rights under the law. As mentioned, a partnership is owned by partners who sign a partnership agreement. But what is a partnership agreement? The agreement usually covers the following: capital invested, profit and loss sharing, interests on capital or drawings, salaries or bonuses for partners, partner loans, and management responsibilities. Going back, I want to emphasize the phrase practice a profession. Professions that are regulated, like accountants, architects, doctors, engineers, and lawyers, they cannot form corporations because it goes against public policy and may let them avoid personal responsibility for their work. Now, why is that so? If these professionals were allowed to form corporations, they could avoid being personally liable for mistakes, negligence, or malpractice. For example, if a doctor makes an error or an accountant commits fraud, they must remain personally accountable. Allowing them to hide behind a corporation would be unfair to clients and the public. As previously stated, a corporation is a separate legal entity. Being a separate legal entity entails being treated as its own person in the eyes of the law. This means it can sue or be sued in its own name, make transactions under its business name, and is required to pay corporate taxes. Now let's talk about the number of owners. In a sole proprietorship, there is only one owner. From the word sole, which means one and only. In a partnership, there are two or more owners called partners. In a corporation, there can be one or more owners. Ownership is divided into shares of stock, and the owners are called stockholders or shareholders. Next, let's take a look at business life. For a sole proprietorship, the business ends when the owner dies, cannot continue operations, or decides to close. For a partnership, it ends when the agreed term finishes, when a partner withdraws in good faith, when a partner dies or becomes insolvent, or by court order. For a corporation, it can continue indefinitely. It only ends if it goes bankrupt or when the stockholders vote to liquidate. As noted earlier, owners of a corporation are called stockholders or shareholders because ownership is divided into shares of stock, which are evidenced by a stock certificate. By law, a corporation has perpetual existence unless stated otherwise according to the Revised Corporation Code. Finally, let's see who is responsible for business debts. In a sole proprietorship, the owner has unlimited liability. This means they are personally responsible for all debts, even up to their own assets. For example, if the business cannot pay a loan, the owner's personal savings or property may be taken to cover it. In a partnership, Partners are both individually and jointly responsible for debts. If one partner cannot pay, the other partners may have to cover the debt. In a corporation, stockholders enjoy limited liability. They are not personally responsible for debt. Their risk is only up to the amount they invested. If the company goes bankrupt, stockholders only lose what they put into buying shares, not their personal assets. Lastly, we have GAAP, which means Generally Accepted Accounting Principles. These are rules and standards from the Financial Accounting Standards Board that guide accountants in recording transactions and preparing financial reports. And that concludes the introduction to accounting. Here are my references. These are all based on my notes and handouts during freshman year. So thank you, Sir Espirito and Miss Trinidad, for teaching these topics so well. But wait, there's more. I strongly believe that accounting, just like life, is something you cannot handle by effort alone. Numbers, reports, and decisions can get overwhelming. In the same way, in life, we also face situations we can't solve on our own. That's why I believe we all need divine intervention, guidance that goes beyond our own strength. Since we've just talked about the introduction to accounting, I'd like to give a quick introduction to the Bible, which I believe is even more foundational. At the very heart of it is this powerful verse in John chapter 3 verse 16. For God so loved the world that he gave his only begotten Son, that whoever believes in him should not perish but have everlasting life. In accounting, we talk about balance sheets, assets, liabilities, and equity. Everything has to balance. In life, sin creates a debt we can't pay. But John chapter 3 verse 16 shows us that God already provided the payment through Jesus Christ. That's why this verse is like the ultimate audit of God's love. It assures us that whoever believes in him will not be bankrupt in spirit, but will have eternal life. I hope you learned a lot in today's video. God bless and see you in the next one.